Good morning. Welcome to your daily solo 401k webinar and Q&A session with my solo 401k financial, where we try to help you to stop overpaying taxes and start building real retirement wealth. So today's topic deals with self-directed IRAs, specifically what transactions in a self-directed IRA. We're going to unpack that. Also, this is your chance to get answers. So use the chat to ask questions. Go ahead and type them over. They can be surrounding any aspect of self-directed IRAs, solo 401k plans as well. Go ahead and type them over and we'll pause and answer those questions as they come in. So what transactions are prohibited in a self-directed IRA? Well, self-directed IRAs offer investors the freedom to diversify beyond traditional stocks and mutual funds into alternative assets such as real estate, private equity, private lending, and precious metals. However, this flexibility comes with strict IRS regulations. So one of the most important rules to understand involves prohibited transactions. Violating these rules can cause your entire IRA to lose its tax advantage status, resulting in immediate taxation of the full IRA account, and also potential penalties on top of that. So let's break down exactly what transactions are prohibited in a self-directed IRA. Here's a question here. I have a solo 401k. Do I need to open a self-directed IRA? Typically, no. Most individuals prefer the self-directed solo 401k over the self-directed IRA from a number of items, and we'll cover that topic in future webinars. We've actually done a webinar on that topic, but it doesn't hurt to do a refresher. However, it is good to know that a solo 401k can also be self-directed. As a matter of fact, a lot of the same prohibited transaction regulations that apply to a self-directed IRA also apply to a solo 401k plan. In some cases, you actually do need both a solo 401k and a self-directed IRA. For example, let's say that you have a former employer. Well, let's say you have a Roth IRA and you want to self-direct that Roth IRA. Well, the 401k, the solo 401k allows for Roth solo 401k funds. However, the Roth IRA regulations do not allow for the transfer of a Roth IRA to a Roth solo 401k or any type of Roth 401k. So that's an example where if you want to invest your Roth IRA funds in alternative investments like precious metals, real estate, promissory notes, and so forth, even private equity, then that's where you may want to open up a self-directed Roth IRA. So that would be a good example. Okay, good question. Let's see if we have we'll take a look at some more questions here in a moment. So again, we're talking about what transactions are prohibited in a self-directed IRA. So we'll take a look at some of the questions here. Again, go ahead and type your questions over. They don't have to be specific to today's topic. They can be regarding solo 401k plans and any aspect of self-directed IRAs as well. So what is a prohibited transaction? When we're talking about a self-directed IRA. So a prohibited transaction happens when your IRA engages in a transaction that directly or indirectly benefits you as the IRA participant or certain related parties. Also, it involves specific disqualified persons, and we'll talk more about that in a moment. It also constitutes self-dealing. It also includes certain prohibited asset types, such as collectibles, and we're going to shed more light on that. So the IRS rules are designed to ensure that your self-directed IRA is strictly used for retirement purposes, not for current personal benefit. And that's actually a very good distinction there. That is, that self-directed IRAs are meant to be used for retirement purposes, not for current personal benefit. So transactions with disqualified persons. Well, your IRA cannot engage in certain transactions with individuals or entities known as disqualified persons. And again, a lot of these rules also carry over to a self-directed solo 401k, especially when we're talking about disqualified persons. So those of you who also have self-directed solo 401k plans, you want to listen carefully. So who is a disqualified person? Well, according to the Internal Revenue Code, disqualified persons include you as the IRA participant, aka account holder, IRA holder, your spouse, your parents and grandparents, your children, grandchildren, any fiduciary of your IRA, or even the custodian or the advisor of your IRA. Those are all disqualified persons, and also any entity in which you own 50% or more and more interest. So in short, you cannot perform transactions with your self-directed IRA with this list of parties. And you can learn more about these regulations and disqualified parties by referencing IRS code 4975, which is the section of the IRS code that deals with prohibited self-directed IRA transactions. So obviously understanding this list is critical because many prohibited transactions stem from self-dealing with these individuals or entities. And again, this same list here applies to solo 401k plans. So let's talk about a prohibited transaction with a disqualified person. So let's talk about some of the most common violations regarding self-directed IRA investments and prohibited transactions. One would be buying or selling a rental property. So your IRA cannot buy property from you or sell property to you. Same rule applies to a self-directed solo 401k plan. Your self-directed solo 401k cannot buy property from you and vice versa. You cannot sell property from the self-directed solo 401k to you. That's prohibited. For example, you cannot sell real estate you personally own to your IRA. Your IRA cannot purchase your child's rental property. Also, if your self-directed IRA or self-directed solo 401k owns a rental property, if your kid's going off to college, he or she cannot use that property as a personal dwelling, even if he or she pays fair market rate. It's prohibited, it's disallowed. Another example is lending or borrowing money. So a self-directed IRA You cannot have a self-directed IRA process a promissory note to you or a disqualified party as described above. Now, that's different with the solo 401k plan. With the solo 401k plan, you can actually borrow from the solo 401k plan through a participant loan, where you can borrow 50% of your solo 401k balance, not to exceed $50,000. So that's one of the big differences between a solo 401k and an IRA, is the ability to borrow from a solo 401k. So an example regarding the self-directed IRA is that your IRA cannot fund a personal loan to you. And obviously you cannot personally lend money to your self-directed IRA. There is an exception to that, but I'm not going to get into that. Okay, so another example is providing goods, services, or facilities to your self-directed IRA. So your self-directed IRA cannot engage in business transactions with disqualified persons. That is the IRA participant, which is you. So for example, if your self-directed IRA owns a rental property, you cannot hire your spouse to manage that property with regards to performing repairs, um, other sweat equity type of work. Your child cannot live in that IRA owned property, again, even if it's at fair market value, if he or she pays fair market value. You also cannot have personal use of the self-directed IRA assets. So if your self-directed IRA owns an asset, you cannot use it personally. So precious metals, real estate. So again, an example would be you cannot stay in a vacation home owned by your self-directed IRA, even if you pay market rent. Also, you cannot build your personal residence or on land owned by the IRA. Many individuals like to invest their self-directed IRA in vacant land. Well, you cannot turn around and build your personal residence on that vacant land that's owned by your self-directed IRA. There's also restriction on loan guarantees. So your self-directed IRA cannot guarantee a loan for you. So let's say you want to buy primary residence. You cannot use your self-directed IRA funds to guarantee that loan. So those are some items to understand. Let's take a look at some questions here, and then we'll talk about self-dealing and indirect benefit regarding a self-directed IRA. Let's see here. So let's see. Here's a question here. I established a solo 401k in 2025. In 2026, I funded the employee portion of the 401k. Okay, so far so good. I'm getting ready now to fund the employer. That's good. So that's all in compliance. Keep in mind the solo 401k regulations allow you to make all contribution types, whether pre-tax employee, pre-tax Roth, whether employee pre-tax contributions, employee Roth contributions, employer pre-tax contributions, employer Roth contributions, as well as voluntary after-tax solo 401k contributions. Those can all be made in the current year for the prior year by your business tax return due date plus timely filed extension, especially if you set up the plan by December 31st of the prior year or in prior years. Okay, let's see if we have some more questions here. Looks like, here we go. I am now getting ready to fund the employer portion. How do I fund the Mega Backdoor Solo 401k in 2026? Well, looks like you have two questions going on here. You're looking to make both employer contributions and voluntary after-tax solo 401k contributions. So keep in mind that you cannot contribute more than the overall limit for the year. So for tax year 2025, the overall contribution limit is what, $70,000? So you cannot contribute more than $70,000, especially if you're under age 50. It's also important to understand that voluntary after-tax solo 401k contributions can never be applied as a catch-up contribution. They're always applied as normal contributions. So if you already made employee contributions, then you can make some employer contributions and voluntary after-tax solo 401k contributions as well. But it's important to understand that you cannot go over the overall limit for the year between all three contribution types. So you'll want to make sure that you do not go over the annual contribution amount. Some clients forego making any other contribution and they just make voluntary after-tax solo 401k contributions only. So they'll contribute the full $70,000, for example, to the voluntary after-tax solo 401k. So they'll contribute it to this bucket right here. Let me pull that bucket up here. They'll make the contribution to this bucket right here, the voluntary after-tax bucket, the full $70,000. So that means they cannot contribute any more funds to the plan because they're under age 50. So they'll put that entire $70,000 into the voluntary after-tax solo 401k bucket, and then they'll convert it to the Roth solo 401k or to the Roth IRA. But the takeaway here is that you cannot contribute more than the overall limit for the year. And if for 2025, that overall limit is $70,000. For 2026, that's $72,000. And again, you can contribute some pre-tax, some Roth, and some voluntary after-tax. Some clients like to take some deductions because when you make pre-tax solo 401k contributions, whether pre-tax employee or pre-tax employer, that's going to reduce the taxable income for the year, whereas voluntary after-tax solo 401k contributions do not. But the trade-off is that those voluntary after-tax solo 401k funds can then be converted to the Roth solo 401k or the Roth IRA and grow tax-free. Good question. Okay, let's keep going here. Here's a question. Can the employer portion from 2025 be converted this year? Yes, good question. You can process conversions, whether you're converting voluntary after-tax solo 401k funds to the Roth solo 401k or converting pre-tax solo 401k funds to the Roth solo 401k. Those can be done anytime during the year. Don't confuse, and let me see if I can dig up a page from our website on this. Do not confuse the contribution rules with the conversion rules that apply to a solo 401k plan. That happens quite a bit. So remember, contributions to a solo 401k plan for the prior year can be made in the current year by the business tax return due date plus timely filed extension. Whereas conversions, that's different. That's when you convert funds in the plan to the Roth solo 401k, whether you're converting voluntary after-tax solo 401k contributions or pre-tax contributions. Those are considered conversions, not contributions. So those have different rules and deadlines. We actually did a webinar on this topic a couple weeks ago. Let me share the link to that webinar so you can reference it. Take a look at that link right there that breaks down the deadlines and the rules for contributions versus conversions. So conversions are always reported in the year that the funds are actually converted from the pre-tax solo 401k or the voluntary after-tax solo 401k to the Roth solo 401k plan, which is different than contributions. Contributions, as I already mentioned a couple times, but it doesn't hurt to say it again, those have different deadlines. You can make contributions in the current year for the prior year by the business tax return due date plus timely filed extension. But take a look at the link there. Okay, let's take a look. Let's continue with today's topic, and then we'll come back and keep answering some more questions here. So we've been talking about what transactions are prohibited in a self-directed IRA. We talked about self-dealing already. So give me a moment here while I pull up that slide here. So let's talk about self-dealing, however, an indirect benefit. That's pretty important to understand. So again, in the context of a self-directed IRA, even if no disqualified person is directly involved, you can still trigger a prohibited transaction through self-dealing. So self-dealing occurs when you personally benefit from a self-directed IRA investment outside of proper retirement distributions. And again, these same regulations will apply for the most part to a self-directed solo 401k plan. These self-directed IRA prohibited transactions and examples of self-dealing. So an example of self-dealing is sweat equity. So if your IRA owns a rental property, you cannot personally perform renovations or repairs. So you're going to have to hire a contractor to perform those functions. And of course, that contractor cannot be your spouse, your children, your parents, and so forth. We talked about disqualified parties already and went over that list. You also cannot contribute unpaid labor to increase the property's value. So you can't say, well, I'm going to go ahead and do these repairs, and my self-directed IRA is not going to pay me, but I'm going to go ahead and do them anyways. That's not allowed either, whether you get paid or not. So again, you must hire unrelated third parties and pay them from the self-directed IRA, because the self-directed IRA owns that property. So you have to make sure that IRA funds are used to pay those contractors for that work and or repairs performed on the property. Personal enjoyment. No vacation in self-directed IRA that's owned by the no, you cannot vacation in a property that's owned by your self-directed IRA. Okay, paying personal expenses. You cannot use your self-directed IRA to pay personal bills, even if temporarily. That's prohibited. You can always take a distribution from your self-directed IRA, a taxable distribution, but that's different than trying to use the self-directed IRA funds indirectly to pay personal bills. When you take a distribution from a self-directed IRA, you pay taxes on that amount distributed, and therefore you can do whatever you want with those funds. That's different than this example here. Now let's talk about prohibited investments inside a self-directed IRA. So while self-directed IRAs allow many alternative assets, such as we've been talking about here, rental properties, vacant land, promissory notes, whether secure or unsecured, tax liens, private equity, the list goes on and on. The IRS does prohibit most collectibles. So a self-directed IRA, and same rules apply to a solo 401k for that matter, are not allowed to invest in most collectibles. So what are some examples of prohibited collectibles? Well, artwork. So you might have a favorite painter and you want to use your solo 401k or self-directed IRA to buy art from that painter. Well, that's not allowed. Also, rugs. Maybe you took a nice trip over to the Middle East and you found a nice Persian rug that you like. Well, that's disallowed. You cannot use your solo 401k or your self-directed IRA to invest in rugs, even Persian rugs. Also antiques. Whether you drove across the good old USA and made a pit stop at an antique shop and you found that antique that you've been looking for years, that's nice, but you're not allowed to use your solo 401k or your self-directed IRA to invest in antiques. Now, most metals are also prohibited. However, there are some allowed metals that can be invested, but that can be held in a self-directed IRA or even a self-directed solo 401k. They generally have to be a certain type and a certain purity. The purity generally needs to be 0.9995 and up. And also, it has to be certain types of precious metals, such as gold and silver. For example, a common investment in metals are American Eagle coins, whether they're silver or gold. Those are allowed self-directed IRA and even self-directed solo 401k investments. And we have seen an uptick in those types of investments in the last couple of years due to the huge increase in both gold and silver prices. You can also invest those solo 401k in other types of metals like Canadian maple leaf coins, whether gold or silver. I know that the Credit Suisse PAMP Swiss bars are also very popular. Also, US Buffalo Gold, that's uncirculated coins, no proofs. Solo 401k or the self-directed IRA cannot invest in proofs. As example of other metals are bars and rounds, but they have to be produced by manufacturers that are accredited by NYMEX, COMEX, and so forth. So those are important things to understand. Now, some example of disallowed metals, especially precious metals inside a self-directed IRA or a solo 401k would be Austrian 100, 20, and 10 coronas, the Belgian 20 franc, the Dutch 10 guilder, the French 20 French, and so forth. And of course, another one we oftentimes get questions on is the South African Krugerrand. I'm not sure if I'm pronouncing that correctly. So those are not allowed types of metals. Other types of prohibited collectibles inside a self-directed solo 401k would be gems. So whether we're talking about diamonds or emeralds, whether you took a nice trip down to Colombia and visited a gem mine and now you want to buy some gems, you cannot do that. You cannot purchase those gems with self-directed IRAs or solo 401k plans. Same thing with stamps and musical instruments. And of course, alcoholic beverages, such as wine and liquor, those are all disallowed. And again, we already talked about the exception, which is certain bullion and coins that meet specific IRS finance requirements. Those are permitted. So always double check before you make an investment in any type of precious metal, whether you're using a self-directed IRA or a solo 401k plan, to make sure that those are allowed metals. Now, before we talk about what happens if you violate the self-directed IRA prohibited transaction rules, let's take a look at some more questions here. So, here's a question here. If I retire, let's say in a year, I will have to close my solo 401k. Can I transfer the solo 401k to a self-directed IRA? Yes, you can. Great question. A lot of our clients invest their solo 401k plan and alternative investments like real estate. And once they stop being self-employed, where their business closes, they can no longer continue with the solo 401k plan because you must have a business to sponsor any type of 401k. So if your self-directed solo 401k owns real estate, then you do not have to sell that property. You can actually transfer that property in kind to a self-directed IRA. And let me see if I can share a link from our website here. Let's see here. I'm going to share 3 links from our website here that you can take a look at for more information. As a matter of fact, I'm going to have to share them one by one. So give me a moment here. So there's the first one, titled "When Can You Close a Solo 401k Plan?" Here's another one titled "When Do I Need to Close a Solo 401k Plan?" Take a look at that there. And then the third one is "How to Properly Close a Solo 401k Plan." And then I'm actually going to provide one more, which is "How to Transfer a Solo 401k to a Self-Directed IRA." So give me a moment here. See if I can pull that up here. But the property would be assigned, the solo 401k owned real estate property would be assigned from the solo 401k plan to that self-directed IRA. Here's the link here about transferring a solo 401k. So you would need to work with your county recorder and having that property granted to the self-directed IRA custodian. And then we would help you to close the solo 401k plan by issuing a Form 1099-R to report the full non-taxable transfer, actually direct rollover, and then a final Form 5500 easy. But take a look at those links I just shared with you. Here's a question. Can a solo 401k be converted to a W-2 401k plan? Yes, you can. That's called a restatement. You can restate the solo 401k to a full-time employer 401k for your business, or you can transfer it to a full-time employer 401k if you work for an employer that offers a 401k. So that would result in having to issue a final Form 1099-R and a final 5500 easy to close that plan. So take a look at those links I shared earlier. But good question. Okay, so here's a question here from I think, let's see here. Give me a moment here. Here's a question. How are spouse contributions to a solo 401k properly conducted? Must one be given a 1099-R? Is there another way? Well, number one, let me share a link from our website, but as long as both spouses are self-employed in the same self-employed business, it's considered just one plan. So depending on how that business is taxed, that's how you would determine the contributions and the reporting. So let me share a link here. We did a webinar on that topic, actually. Let me share that with you and take a look at that. We have over 1,100 videos on our YouTube channel on all these various topics that we've done webinars on. Take a look at that there. But in short, let's say your self-employed business is taxed as an S corporation. That means that each of you, and then if you're both working for that same business, then it's one plan, and both of your respective contributions to the solo 401k plan are going to be based on your respective W-2 wages from that business. Here's an example of a 2-participant plan, 2 spouses, for example. It's still one plan, which is sponsored by the same self-employed business, and you each have separate bank or brokerage accounts under that same plan to hold your respective funds. This is an example of where you would have 6 separate holding accounts, 3 for each spouse, pre-tax, Roth, and after-tax. Of course, you don't have to make all these contributions every year, but the plan allows for all these contribution types, and you don't lose that feature by not making those contributions. And then you're going to report those contributions on your business and personal tax return, depending on the type of contributions. Let me share a link from our website that talks about how to report contributions. Give me a moment here. Take a look at that. That's got some good, it's actually got a good live webinar we did, and also a good presentation and slides, or I should say cheat sheets on there that explain how to report contributions. So take a look at that there. And that would apply for both participants in the plan. Okay, let's see if we have some more questions here. Yeah, if you're both self-employed in the same, let's say the LLC is taxed as the sole proprietorship, that's one plan. Both of you are working for that LLC. So it's one plan sponsored by the LLC that's taxed as the sole proprietorship. That means you each would file a separate Schedule C. So the contributions to the solo 401k plan would be calculated based on your respective Schedule Cs. And again, take a look at that link I just shared with you that talks about how to report contributions for each entity type, whether it's an S Corp, sole proprietorship, or partnership. And I'm going to share a specific page regarding sole proprietorships as well. Let me share that with you. There's a nice webinar that we did on this topic there as well. So take a look at that. Okay, let's continue with our webinar, and then we'll come back and look at some more questions. So if this information is helping you feel more secure about your future, please take a moment to like and subscribe. It'll really help us to get the word out to other self-directed IRA and solo 401k investors so that they can find this great content that we deliver every day. Also, subscribe to our YouTube channel, where we have over 1,100 videos that you can access. Please like us across the various social platforms as well. Let's get back to again, so we're talking about what transactions are prohibited in a self-directed IRA, and we've been also answering questions about solo 401ks. So today's presentation, while it's regarding a self-directed IRA, you can also ask questions about other self-directed IRA topics, as well as, of course, solo 401k plans. So what happens if you violate the rules regarding self-directed IRAs? Well, in short, the consequences can be very severe. So the entire IRA may be treated as a distribution, and penalties may apply. So immediate taxation of the full account value, and also depending as to when that prohibited transaction occurred and what year, you're going to have to go all the way back to that particular year and count it as a prohibited transaction for that year, meaning you're going to have to pay back taxes and penalties, and you're also going to have to amend your personal tax return. And if you're under age 59 and a half, you're also going to have to pay a 10% penalty. So in short, one mistake can eliminate decades of tax-deferred growth or tax-free growth if we're talking about a self-directed Roth IRA. So how do you stay compliant with the self-directed IRA when you're making investments? Well, know who is disqualified. We talked about that already up above as far as the list of disqualified parties. So you want to make sure you keep transactions completely separate from yourself and family members. Also, you want to avoid personal benefit. Your IRA investments must be strictly for retirement, not for current use. You always want to keep transactions at arm's length. That's a terminology you always hear across the self-directed IRA industry. So you want to treat your self-directed IRA like a completely independent entity, dealing only with unrelated third parties. And of course, you always want to seek professional guidance before you make self-directed IRA investments. Now let's do some final thoughts on today's topic, which is what transactions are prohibited in a self-directed IRA. So a self-directed IRA offers tremendous flexibility and diversification potential. However, this flexibility comes with responsibility. So the IRS prohibited transaction rules exist to prevent abuse and ensure that retirement accounts like self-directed IRAs, self-directed solo 401k plans as well, are used exclusively for retirement purposes. So by understanding who is disqualified, you're going to be able to avoid self-dealing and also steering clear of, you also want to make sure you stay clear of collectibles. And you also want to keep all transactions at arm's length. And this way you can protect your self-directed IRA's tax advantage status so that you can confidently grow your retirement wealth. So if you're considering alternative investments inside your self-directed IRA, make sure compliance is your first priority, because one prohibited transaction can undo years of strategic planning. Okay, let's see if we have some more questions here. Looks like we got Mr. Nelson coming back here for some more questions. No LLC. What if the sole proprietor were accidentally made for gross and not net earnings? Well, you're going to have an excess contribution on your hands. So you need to be careful when you make solo 401k contributions not to contribute over the allowed limit, because it can result in an excess contribution. Let me share a link from our website that talks about the excess contribution rules as they apply to a solo 401k plan. Give me a moment here. I need to dig it up here. But the excess contribution rules are two-pronged. You first need to identify whether it was an excess employer contribution or whether it was an excess employee contribution. If it was an excess employer contribution, then those funds typically have to stay inside the solo 401k plan, and you're going to have to count them as contributions in future years. If it's an employee contribution, you typically have to remove it, and you're going to have to pay taxes on any earnings. You have to remove the basis and the earnings. Let me share a link with you here. Take a look at that link right there. And you're going to have to work with your CPA in properly performing the removal of those excess contributions on a Form 1099-R if they're employee contributions. Okay, so that's it for today's topic and live Q&A session. Thank you so much for investing your time with us. We know your time is valuable, but we think your retirement future depends on it. Again, if you haven't yet, please like and subscribe so that we can keep building this community. We'll be back here again, actually, in a couple hours with more great live content. Until then, have a good rest of the day.